Fundamental analysis is a method used by investors to evaluate stocks based on various quantitative and qualitative factors related to a company's financial health, performance, and market position. Here's how you can use fundamental analysis for stock picking. Understand the basics. Financial statements. Review a company's financial statements, including the income statement, balance sheet, and cash flow statement. Analyze revenue trends, profit margins, debt levels, and cash flow generation over multiple periods. Evaluate financial ratios. Profitability ratios. Assess metrics like return on equity, ROE, return on assets, ROA, and gross profit margin to gauge how efficiently a company generates profits relative to its equity and assets. Liquidity and solvency. Examine liquidity ratios, current ratio, quick ratio, and solvency ratios, debt to equity ratio, interest coverage ratio, to determine the company's ability to meet short-term obligations and manage long-term debt. Assess growth prospects. Revenue growth. Analyze historical revenue growth rates and forecasts for future growth. Look for consistent revenue growth in core business segments. Earnings growth. Evaluate earnings per share, EPS, trends and profitability trends. Determine if earnings growth is sustainable and aligned with market expectations. Study industry and market position. Industry analysis. Understand the company's industry dynamics, competitive landscape, market share, and barriers to entry. Compare the company's performance against industry peers. Market position. Assess the company's competitive advantages, e.g., proprietary technology, brand recognition, and market positioning relative to competitors. Management and governance. Management team. Evaluate the experience, track record, and strategic vision of the company's management team. Assess their ability to execute business strategies and adapt to market challenges. Corporate governance. Review corporate governance practices, board structure, executive compensation, and shareholder-friendly policies. Economic and market trends. Macroeconomic factors. Consider broader economic trends, interest rates, inflation rates, and consumer sentiment that could impact the company's operations and financial performance. Market sentiment. Monitor investor sentiment, analyst ratings, and market expectations regarding the company's growth prospects and stock valuation. Valuation analysis. Valuation metrics. Use valuation ratios such as price to earnings, P/E, price to sales, P/S, price to book, P/B, and enterprise value to EBITDA, EV/EBITDA, to assess whether the stock is undervalued, overvalued, or fairly valued compared to peers and historical averages. Discounted cash flow, DCF, analysis. Estimate the intrinsic value of the stock based on future cash flow projections, applying a discount rate to account for the time value of money. Risk assessment. Risk factors. Identify and evaluate risks specific to the company, industry, and broader economic environment. Consider operational risks, regulatory risks, geopolitical risks, and financial risks that could impact investment returns. Monitor and reassess. Ongoing analysis. Continuously monitor company news, earnings reports, industry developments, and market trends. Regularly reassess your investment thesis and adjust your portfolio allocation based on new information and changing market conditions. Seek professional advice. Financial advisors. Consult with financial advisors, analysts, or investment professionals who specialize in fundamental analysis and equity research. They can provide insights, recommendations, and independent perspectives to support your investment decisions. By conducting thorough fundamental analysis, investors can make informed stock-picking decisions based on the company's financial performance, growth prospects, competitive strengths, and market valuation. This approach helps mitigate risks and potentially enhance long-term investment returns in the stock market.